Good afternoon, everybody. Welcome to Trader Merlin Show. We have a special show today, given the fact we had a rate announcement today. Of course, a little bit of a surprise there for me, not to Margaret and a couple of others that watch the program. They were expecting 50 basis point cuts from Jerome Powell and the FOMC crew. We'll talk a lot about that today. And of course, I could do it by myself, but I just wouldn't do the whole topic justice. Therefore, we're going to have our resident bond market expert, Mr. Bill Addiss, will be joining us today. I'm assuming you're on the East Coast today, Bill.
I am in miserably cloudy, rainy Washington, D.C. suburb right now.
Nice. Well, we're back to great weather out here. I'm pretty happy about it. I got my 70-degree temps and nice sunshine. Of course, I'm headed to Vegas, where I think it's going to be much hotter than that. But
you're killing me.
I know. I try my best. Talk to me a little bit about today's FOMC announcement, takeaways, things that you thought were surprising or not surprising. And I have a feeling we're going to have some debates going on today, so this is going to be a good one.
First off, as we know, no surprise. This was the most telegraphed rate cut ever. And, if we look at the futures markets, as of Friday last week, the futures markets was pricing a greater probability of 50 basis points than 25. And this week, that probability continued to increase. So by the time we got to this morning, the futures market was pricing in a 78% probability of 50 over 25. So no surprise there. I also, if we get a minute, I want to explain, because the Fed actually cut 4 rates today.
Right.
So I think maybe we could explain. But, what we're talking about in this part of the conversation is the Fed funds rate, right? The rate that the Fed uses as their primary monetary tool. So they feel comfortable enough with inflation under control. And I think, we didn't have this discussion, but I think the Fed at this point is entitled to take a victory lap.
Yeah, it's funny.
They've now gone a full cycle.
I was actually on a show today, and someone asked about, is this the Fed taking their victory lap? And, I think they certainly deserve to do so. But you and I were talking a little bit before the show, and we'll go to these slides here in just a second. But in my mind, my viewers kind of know my perspective on it, so I'll keep it brief. But in my mind, I'm looking at the actions of the Fed. And, of course, if everything is going smoothly and everything seems to be running on all cylinders, which, if you read through the minutes and the notes that was given at the press conference today, everything looks pretty darn good. I'll read through some quotes in a minute, but if that's in fact the case, if everything looks fine and dandy, we're headed towards our 2% inflation target, currently 2.5 on CPI, slight increase in unemployment, we're at 4.2%. Even Powell said anything in the low 4s is really good. Then why cut 50 basis points? Doesn't that represent a shock to the system where you could potentially do more damage than good? Because you're not incrementally changing something. Like if I want to add some salt to a meal, I'm going to do a pinch of salt first, not a full-on tablespoon, which is like what happened today.
I'm going to agree with everything you said up until like the last 30 seconds. In terms of the economy, there's no doubt things are going well. Employment, a little fuzzy, but the economic data reads good. I do agree with that. But the other problem, what I'm going to disagree with is that I don't think 50 basis points is a big move. The problem is many people are looking at this at a context of, yes, for the last 10 years, with the exception of the pandemic, when the Fed intervened, they did tend to do it in 25 basis points. We said if the Fed hikes 4 times, it was just assumed that was going to be 1%. But that's not a historical context whatsoever. 25, 50, 75. I'm going to really date myself. The Volcker days when they did 600 basis points in one meeting.
Wow, that's a little different. You had to walk through through the snow both ways, uphill, backwards back then.
Exactly.
Different era. Well, let me bring up this chart here. This is just for historical basis, and I know you can't see this chart, but I'm just looking at the historical cycles of rate cuts. And you look back here in 2000 when the markets started to go to hell in a handbasket, when we had huge crashes in the equity markets. They were dropping 50 basis points at a clip to really get this under control. And then on the way up in 2004, you can see 25s just nonstop. Now, as they came out of that in 2007, of course, this was the financial crisis, but in September of 2007, they did a 50 basis point cut. And that's what started. They went from 50 to a quarter, and then 75. That was more of a panic thing. I guess in my neophyte, my youngster perspective of the Fed,
that's right.
25 basis points seems normal, nice, calm, incremental steps. Where 50, while you're right, it doesn't mean the end of the world. It just seems like a much larger shot across the bow that something is a stinky up ahead.
Yeah. And obviously the market is, some people in the market are going to perceive it that way. From that point of view, the Fed was damned if they did, damned if they didn't.
Yeah.
I also believe that Powell, the Fed has been accused, and I think you've done it too, I have, of being a little late to the party sometimes.
Yeah.
That they're way too slow in responding. And we certainly saw that with inflation. So, what's to say that isn't also a factor that they don't want to continue to be accused of coming late to the party?
Agreed.
And I'm going to add a third variable that I hate to admit, but I have to believe it could be a factor, is politics.
Yeah. Yeah. And he was asked that at the press conference. I found that interesting. So he's, of course, he said, no, we're not talking, it's not influencing us at all. And I was like, okay, whatever. You can try to convince me all you want. I do feel there's some there, but whatever, we'll let it be. You're one that hangs on like almost every little word change at these announcements. I love it. I love it because he said maybe as opposed to possibly. Holy cow, the sky's falling. What, from your perspective, what are the two mandates of the Fed? What is the Fed responsible for?
Well, as per the Humphrey-Hawkins Act, the Fed has two dual mandates: is price stability and full employment.
That's it, right?
And as we know, and that's it. I mean, yeah, from a mandate point of view, they have operational things they have to do, supervision and wiring money, but their monetary policy mandate is those two,
right?
Which we continue to talk about are at their extremes mutually exclusive.
Right. Now, I wrote this down. I took time with my chicken scratch scribble over here to write this down because I know you hang on words. So here's what he said today. He says, we know that reducing policy restraint could hinder progress on inflation. At the same time, reducing restraint too slowly could unduly weaken economic activity. Okay. Wait, that's not your mandate. You don't have squat to do with economic activity and unemployment, right? So you tied those two together. I thought that was somewhat interesting because he kind of, he shouldn't have said that. Just said inflation and unemployment, but he threw in the economic activity part, which of course they're looking at. I know, undeniably.
Yep. But I'd also like to point out, and it was pointed out to me by a talking head on Bloomberg, I didn't come up with this, but this is, to the best of anyone's knowledge, the first time that the Fed has entered into a rate-cutting mode when they haven't actually achieved their goals.
Yeah. Yeah, that was interesting.
Yeah, what's the implication of this? How rubbery, how bouncy is inflation going to be? Does this present a risk? I don't know. I'm just pointing it out. But we talk about unprecedented. This is kind of unusual. It'll be interesting to see how this plays out.
I am in the camp of, I think that this does create problems for inflation. You've been raising rates aggressively, and albeit very aggressively, to help bring it down, which they've done. We've gone from 10-ish% down to 2.5 on your CPI, but that's still not the number you said you were going to reach is 2%. And now you're all of a sudden going to cut again, adding a little bit more fuel to this fire, which could theoretically push inflation back up. Like, don't we want to be done with this first before we start making changes? That's, I guess, why I'm confused on today's actions.
No, and I've been of that camp, as you well know, the screaming, why are we talking about cutting? The Fed never achieved their goals. But, the marketplace priced it in as the probability. I guess the market doesn't listen to you and I directly, Merlin. I don't know what's going on.
Market doesn't care about me, and it's all right. I don't really care about the market either.
But I would point out exactly what you're saying is exactly what happened in the bond market this afternoon. If I could for just a second, it was fascinating. I couldn't keep up with the changes quick enough and put together any kind of notes for you guys today. So when the Fed dropped the short end by 50 basis points, they hold that end of the string. Mm-hmm. So the 5 1/4 instantly became 4 3/4 effective tomorrow morning. And then the further we went out in maturity, yields came down, but substantially less. The 10-year was down by only 13 basis points. The 20-year was down by only 5 basis points. And, that directionally, at least there was some unanimity there, even if the velocity of the move was different. Mm-hmm. However, within an hour, the long end of the market completely reversed itself. So now we've got the short end continuing to drop, thank you to the Fed, but yet long-term interest rates are now finishing the day on the day. I mean, the 10-year is 3 basis points higher than it started the day, and it had been 9 basis points lower. We're seeing huge volatility, but what is that telling us? Exactly what you said. The bond market, by such an aggressive move by the Fed, is now worried about inflation again.
Yeah.
Then they're pricing that into the market. The more the market expects inflation, the higher long-term rates go, it compensates for that expectation. So the marketplace is saying exactly what you're saying. Hey, maybe we're a little too aggressive here. Too cheap money is going to fuel inflationary problems because we never hit our goals.
Right. Yeah, we're not totally out of the woods yet. It's interesting the way that dynamic changed today, and
Yeah.
Again, we won't know for a while. These changes, for those who might be new, it's not like you cut 50 basis points and instantly everything changes. It's all of a sudden a new machine. It takes some time for this to filter through. A mild mentor said between 6 and 9 months, sometimes a year. You might have a different perspective how long it takes, but this is certainly going to juice the markets from money coming in. We saw it in commodities today. Nice surge in gold and silver right off the bat of that announcement. No surprise there.
Yeah. No, I mean, the Fed is easing at a time when some people are questioning why.
I'm in the questioning camp.
You're in that camp.
They talked also about their current securities holdings, and I didn't catch all the numbers there. Did you see that? Are they making changes to their security holdings and unwinding
And
that?
honestly, Merlin, and I apologize in my trying to multitask. I one of the slides I sent to you says the question mark. What's going on with tapering? I unfortunately missed that. I've even gone to the Fed announcements and I couldn't see it. So just for the audience's memory, remember when the Fed was tightening and they were raising rates, another thing they started doing was literally destroying money. They were sucking at one point $120 billion a month that they were destroying, literally, in a way to reduce the amount of money in our market. It's the easiest way. Well, by the time we got to the last FOMC meeting, that amount had been reduced to now only $60 billion a month,
right,
that the Fed has been destroying. And I apologize, I don't have an answer for that.
Okay.
I didn't hear it come up in the press conference, and I looked at the Fed release, and it was a little too comprehensive for me to get to in time. So what are they doing about the burning of money? Are they still going to be doing that? But their balance sheet, as you know, as a result of this year, they have reduced their balance sheet by 1.2 trillion.
Yeah.
And that we
bring
need,
it up
we got too much cash. We got too much cash out there, as you know. And the other question is that repo lending facility, and this is where I get eco nerdy. Some people, their eyes are going to cross now. But one of the things the Fed introduced back after the pandemic, when they wanted to get money out of our economy, is they said to your money market funds and asset managers and pension managers, lend us your capital. You've got cash. Give us your cash. We'll pay you an attractive rate of return on that. I mean, that is exactly why you all in this audience have started earning over 5% on your money market funds, because the Fed has been offering your money market funds this opportunity. And they jumped on board, and we've had nice returns on our money market funds. Well, the question was also, just be aware, by the Fed dropping the Fed funds rate by 50 basis points today, starting tomorrow, your money market funds are going to be lower yielding by about 50 basis points. I mean, that's where you're going to see some immediate impact.
Right.
But the other question is the Fed even going to continue with this program? Do they still continue to want to suck money out of the economy, or are they seeing this as, because this was only introduced in 2024 as a new monetary tool? And I didn't see that mentioned in the notes either.
Yeah, I didn't either. He mentioned at the press conference, he said, we'll talk about our security holdings in a bit. We're going to continue to unwind those, but he never got to I didn't hear him get to those numbers at all. I thought it was
I didn't hear a number come up. Yeah, no, I'm with you, but we'll get an answer. We'll get back to your audience.
Right. So the other part here was the SEP, the Summary of Economic Projections. I'll run through them very quickly. So by the end of this year, guys, they're saying GDP 2%, unemployment 4.4%. We're currently at 4.2. The PCE price index at 2.3%, unemployment rate, you already did that one, and then the Fed funds rate, this was kind of the shocker. He said 4.4% by the end of this year, which it's interesting. If I look at the Fed funds futures, they're already pricing in one more than that. All right. So,
right.
So basically another full percent from this point, which would mean that we would probably have to have a 50 basis point cut here soon, as well as another 25 or maybe another 50. So 350s back to back.
We've got 2 meetings before the end of the year. November 8th is going to be the next date. So that's the next meeting. So yes, so you're right.
November
It's pricing
7th.
in pricing in 250 basis points cuts. Exactly.
Man, I mean, again, I just think that's overly aggressive out there. But that's their SEP. And then, by the way, just for those who want to know, they're also saying by end of next year, 3.4% is where they expect their Fed funds rate to be. Now, remember, these are SEP. These are just the projections from the members of the board there. And that can change. He was asked repeatedly about this at the press conference, and he said, these numbers are as of today, as of today's data. So as we go forward, we'll continue to update you on the unemployment numbers, inflation numbers, growth, GDP, all that stuff. So,
can I elaborate on that for just a moment? Because I had a
100%.
class recently where I got a good amount of questions on those. To explain with those a little bit more, if I could, and they call them the blue dots you hear them referred to in the press. I mean, talk about transparency. I got to put a plug in for the Fed. And then I have to say it, they're a client of mine, so maybe I'm pandering to a client. But I got to give the Fed great credit for transparency. Because what this system that Merlin's talking about is they literally do a poll of the 12 presidents of the Federal Reserve banks here in the U.S. We don't have one Fed. We have 12 Federal Reserve banks, and there's a president to each one. And we polled them as well as 7 members of the FOMC called the Board of Governors, different group. But you get that constituency of approximately 18 people. These are the decision makers who are setting monetary policy. And the survey is telling us with great detail going out, 2 years now, I think, Merlin?
Yep.
What their economic expectations are. I mean, talk about an amazing degree of transparency. I find it amazing. Other countries don't offer this.
I was on with the guys from Ninja Trader today, which, by the way, we'll have them on the program here next Wednesday. We'll have Ninja Trader gentlemen on the program. I'll talk more about that as we go. But that was one of the questions, too, or your statements is like, what would I rather have? Would I rather have this pretty transparent, you kind of know what's coming? Or would I rather have that, here's a briefcase crossing the street. It looks really big. Shock to this. I'll be honest. I'd rather have the unknown because it creates so much crazy intraday volatility that it brings a smile back to my face from my glory day trader days. I would prefer to not know. But it is what it is. We'll take what we have, and the markets are going to give you some opportunities either way. But which would you rather have?
I got to say the old way was a heck of a lot more fun.
Yeah.
It was a heck of a lot more fun. I understand the transparency need. I guess it's an evolution, but from a straight trading, fun, crapshoot point of view, M1 used to come out at 4:00 on Thursday afternoons, and nobody traded the market until 4:09 Thursday, and then we traded for the next 2 hours because M1 was such a factor.
Right.
Those were fun times. I admit it. You can see me smiling even as I look back on it.
I am too. I got this big grin. My favorite thing was watching the Greenspan briefcase cam. I mean, it was hilarious. Listening to Maria Bartiromo going, "Oh, he's crossing the street. Look how thick that briefcase is today. He's got papers hanging out." It's like, it's so funny.
Yep.
Oh, the times they've changed, gotten much more efficient. We've seen the yield curve uninvert. Now I'm going to bring up 2 here. Let's bring up the one that the market says is the yield curve, which is the 10 and the 2. And you can see, guys, here we've been uninverted for a few weeks now, a few days now. That's looking good. The 10 and the 1, which Bill says this is a better representation of the yield curve. We have not reinverted yet. We still are inverted by about 28 basis points. Do you think that the news today of that November 7th meeting pulling this short end, that yield curve down even further, is going to be that piece that gets us back to a normal yield curve?
Yes.
No.
Yeah. It's going to be the 2 factors. We're going to see the short end come down, and what's going to frustrate me is now with this meeting out of the way, the next 8 weeks are going to be spent by the talking heads talking about 20 or 50 basis points for November 7th. So this argument doesn't go away. But 25, 50 short rates are coming down. But as we've been expressing, and as the marketplace priced in just today, that's bringing with it the fear of higher inflation, and that's pushing long rates up. I'm also going to throw in my supply argument. We got a boatload of long-term supply of bonds coming into the market. That's also going to put upward pressure to rates. So we're getting a normalization of the yield curve from the inversion we've had for the last 17 months. Absolutely. And that's why I think, maybe the Fed can take a victory lap.
Victory lap. Well, here is the current yield curve. This is as of yesterday, so it doesn't include the changes made today, which we'll see that update the next day. But you can see that short end of the yield curve still very high. If we get the proposed actions by the Fed and talking about getting down, another 100 basis points maybe by the end of the year, then this would get back to a normal yield curve. Now, one other piece to this, which you've talked about a lot in the past, is the demand for that 10-year. And you talked about, last year, maybe even earlier this year, on how the demand was very high for the 10-year. At this point, it would appear to me that just looking at the picture, that the 10-year bond yields would start to drop more and more, because it feels like people are going to be demanding, rushing to buy those longer term bonds because they know the short end's falling, right? Right now I can buy a short term bond, I'll do fine, or short term treasury, I'll make a better yield than I would with the 10-year. And that might be changing. So as that money starts to flow from the short end of the yield curve to the longer end, those yields are most likely to drop. And we've seen that 10-year yield drop significantly over the past 6 months. What's your kind of prognosis here for the 10-year?
And a great couple of points in there. So I want to go back to a couple, but talking about the change in yield over the last 6 months being significant, and this just stresses what I try and stress all the time of the dynamic nature of the yield curve. And today's a perfect example. Fed drops short-term rates, long-term rates go up. As you pointed out, in that intermediate and long-term sector over the last 6 months, those rates have come down substantial. I mean, mortgage rates are at their lowest rates they've been in 7 months.
Yeah.
And remember, the Fed hasn't touched anything in the short end. This is all activity that's happening in the long end. So my concern is, you're right. We have seen good demand for our treasuries. And if the yield curve gets normal, that will also lend people to want to invest in longer term paper. I mean, your logic is absolutely right. My concern continues to be the supply side of the situation. We have got an unprecedented amount of long-term treasuries maturing in the fourth quarter of this year. The deficit's better than it was last year, but yet we're issuing more paper than we ever have, because we've got this problem of all this paper maturing in the last quarter. And the government doesn't have the money to pay it off, so we just got to issue more.
Right.
So paradoxically, even though the deficit's looking a little bit better, there's even more supply coming in. So that scares me a little bit.
Yeah, so if you have more supply coming in, so if the supply stayed normal and demand increased for those 10 years, the yield would drop.
Correct.
However,
and think of it like any auction, because in that scenario, prices would be going up, right? And if prices are going up, that means yields are going down, just to clarify for the group.
So, based off, no, it's great, because we think of things as being kind of somewhat static, but the truth is they're absolutely very dynamic. So if we have a static market for issuance of 10-year bonds and demand is real high, the yields will fall, price of those bonds will go up. However, if we're issuing record amounts to cover all the deficit that we have and debt that we need to pay, which is the trillions of dollars of interest payments alone, that offsets that demand possibly. So, in my mind, I'm thinking the yields are going to continue to drop. But if we have to sell even more and more, if that sale amount doesn't offset the new demand, then rates may actually go up.
Exactly. So I'm going to put a blatant plug in. So one of the reasons we like treasury auctions is that when institutions, or even you and I as individuals, participate in a new issue treasury coming to market, all that information is disclosed. Mm-hmm. We can see how many hedge funds are buying it, how many foreign central governments, because the bond market is over the counter. We don't normally have that centralization of data. But when these auctions happen, the government takes all that data and distributes it, so we know who's there. Mm-hmm. And that's where we can get a snapshot of what the demand looks like. You and I, I'm sure you remember, we've had instances where the announcement of the results of a treasury auction have moved the equity and currency markets.
Absolutely.
So these things are capable of moving markets. Now, tomorrow, we've got a 10-year auction. So I'm looking forward to seeing the results of that auction. So what I want to mention to the group is on my XLT, which is probably going to be the last week of the month, I'd like to debrief one of those treasury auctions for people so we can explain who's buying it. Are foreign central governments buying it? Is the Fed buying it? Do the dealers, unfortunately, get stuck with it? It can tell us a lot in terms of the demand side of the equation.
Absolutely. And, you're certainly one that's entrenched in who's buying and understanding all that. I live vicariously through you and your announcements.
I have an inordinate affinity for the topic. Meaning I have to get a life.
No, I disagree. I think that if you find something that you're extremely interested in and keeps you motivated and keeps you going, you should keep on doing it. Bill does have a class he teaches for Trading Academy. It's called Canary in the Coal Mine, right?
Yes, somebody Brilliant, came up with that title.
I don't know who that could be.
Who could that be, Merlin?
Yeah, Canary in the Coal Mines. For those of you who have not taken that one, I encourage you to check that class out. There's a couple questions that come through here. Margaret says, Bill doesn't bad fiscal policy inhibit the Fed's monetary policy?
Well, the two operate independent of each other.
In
You know, although there's certainly correlation. You know, and I'm not trying to be in any way political, but it is my bias that the government has done a horrible job on the fiscal side. And I just look at the deficit to substantiate that.
Right.
You know, we borrowed more money than any other government, even on a per capita basis. So that, to me, is a fiscal failure of our elected officials. Now, that does put a burden on the monetary policy side of the equation. But just looking at today, right now, we're talking about maybe the Fed could be doing a victory lap from the monetary policy point of view. You know, so the two are not independent of each other. But, you know, I make the strong argument you don't want them under the same umbrella. I don't want the same people who are making fiscal decisions, the same who are doing monetary decisions. And it works both ways. You know, by the Fed raising the interest rates like they did so dramatically, that really hurt the government, you know, the fiscal side, by now having to pay a lot more to borrow money. You know, you can really say the central bank was kind of working against certain best interests of the fiscal side of the equation.
You know, here's the deficit for you guys to just kind of look at this one. This is showing you the deficit tracker from 2019 to 2024. And you can see it's done by year. So the year starts off fine, and then all of a sudden near the tail end of the year, it just absolutely goes parabolic. This obviously was 2020 when we had the most spending, then followed up by 2021. And here we are in 2024. You know, the third most spending out of all those years, and it's accelerating as we speak. So, you know, we haven't really put ourselves in any better position with all this spending, even though the economy looks decent. We have an incredible amount of deficit. So these bonds that Bill talks about, we have to send more and more and more to pay off the interest on this deficit here.
Yep.
Creepy and ugly. Let's see. What else was there? The surge doesn't reach investors. Is all this good for equities? Good question from Les out in Cape Canaveral. You know, when you have a 50 basis point cut, in theory, that's a market stimulus. Cheaper, easier money. Would you say that's good for the markets or not?
Yes, absolutely. The Fed dropping rates will be good for the equity markets. That's a blanket statement for a whole bunch of reasons. You know, even if you're just doing, you know, academic dividend discount modeling, you know, if you got a lower cost of borrowing interest, that means the equity is worth more. But let's remember, as today is probably going to show, what's important is not what the Fed does, it's what it does relative to the expectation, what's already priced into the market. Right. That's why these, you know, looking at what the futures market is pricing in really is not a lesson in futility. It's telling us what the market is pricing in, right? It's like a corporate earnings, right? If we get a good corporate earnings, that might sound good, but if it's not as good as the expectation, we know that stock's going down. And the same is true with economic numbers. So that's why we spend so much time, and I'm getting really frustrated by it, of the talking heads talking about what the future holds. Mm-hmm. But it also shows you the correlation between interest rates and other asset categories, whether it's currency, whether it's equities. But no, the Fed dropping rates, that's good for the equity market. Absolutely. Lower cost of borrowing for corporations as well.
Yeah, and you know, this was a good question that was asked on the show that I did today about, you know, which markets are going to be benefited most by a rate cut. And Jim and I both agreed that it's going to be small caps. It's going to be the Russell 2000. Yeah. Why? Because these smaller companies have access to more capital, therefore they can grow their businesses, one side. But then the other side is big corporations will have access to more cheap capital, and they can buy the small caps. So you kind of have this double whammy for small caps. And today you saw the Russell was one of your better performers. At one point it was up over 2%, finished 0.96% to the upside, whereas the S&P was actually down 0.36%, and the NASDAQ, where we at the NASDAQ, down 0.48%. By the way, just so you guys notice, for those of you who are trading tomorrow, this goes back to one of the comments, said, you know, it started off real good. We were looking great, all-time highs, and all of a sudden retreated, got right near the bottom there. I think that this is a down day tomorrow. I think you're going to, and you have a shooting star. Yesterday we had one as well. The same low was put in. It's 5,677 on that S&P on the continuous chart. I have a line drawn on there for you. Yes, we did go above this line. That's okay, but we still are respecting this all-time high here. Keep your eye on that, guys. It might be a real nice short for tomorrow as people kind of maybe twist their opinions towards my thought, which is, wait a minute, 50 basis points might have been a little much here. Is there something that we're not seeing? Is there something in the tea leaves that we need to be aware of, and maybe we get a little bit of profit taking? I could be totally wrong, as happens, but so far
I have to
mild
agree with you,
experience.
Merlin, because most of the news in the bond market, most of the movement of rates going higher was after the equity markets closed.
Yeah.
So that's not priced in. So yeah, I think you're going to have a weak day on equities tomorrow, all things being considered.
Sava, is a nice question from Sava. He says, how does this affect the issuance of corporate debt?
Well, great question. And the weird part is we have had a record amount of corporate debt brought to market this year. Record amount. In February alone, we had $500 billion of new issue corporates came to market. And the reason for that is that right now, the credit spread that corporations have to pay over the treasury rate is at a very abnormally low level, which means, quite frankly, corporate bonds for the investor are not particularly attractively priced right now. So corporations have been taking advantage of that. See, corporations honestly don't worry about the risk-free rate, the absolute rate of interest. They can hedge that risk out. Corporations really worry about how much do they have to pay over the treasuries to attract investors. And that differential right now is aberrationally low. That's the credit spread. So we've seen an unprecedented amount of corporates coming to market. The other issue we have is a lot of corporations, like the government, are refinancing their debt.
Right.
They had old higher stuff that they could finally call. So we did see a fair amount of refinancings come into the market this year. But, let's face it, you go into this year, everybody kind of knew the Fed was going to be cutting rates at some point. It seems almost counterintuitive that corporations would rush to issue bonds before that happened, which is what they did. And again, the reason is because of that credit spread, not because of the absolute rate of interest.
Yeah. Yep. It says, a great question from Mark. I think Mark might be in your class. He says, Bill, what does this mean for our TBill ladders? He's currently heavy on the short-term T-bills. This is it'll tweak things a little bit, that's for sure.
Oh, and it has. This is the event we were all waiting for. For those people who might not be aware, during this whole inverted yield curve that we've had for the last 18 months, I was really promoting to the OTA community that this was an opportunity. That if you start investing in a sequence of 1 month T-bills, you'll be getting the highest yield in the market, literally, because the inversion, that's what was happening, and you'd be getting good liquidity. So the inverted yield curve for the retail investor, I was adamant, represented a great opportunity as long as the yield curve stayed inverted.
Mm-hmm.
And, recognizing that we knew the Fed was going to start dropping rates at some point, I've tried to be just as vocal with the OTA community starting about 3 months ago, saying now is the time to start thinking about locking in today's rates for a longer period of time. Maybe create a 3-month ladder, put some of your money at 1 month, some at 2, some at 3. But yeah, with the prospect that the Fed was, going to be dropping that most attractive rate in the market, we had to extend out. In the institutional world, this is called, just extending duration, putting more duration in your portfolio. And that's exactly what we were suggesting, what I thought was a good idea for the retail investor.
Sure. Well, you try to capitalize on something while it's there, but obviously these things are going to change. I think Margaret asked a question about, she says, what about junk bonds and JNK? I think that is just a further extension of corporate, right? You're just looking at just higher levels of risk.
Yes, and the junk market also, although not the unprecedented levels of new issue we've seen out of the investment grade market, we saw a boatload of new issue junk come into the market as well. But again, counterintuitively, those credit spreads, for example, if you had a portfolio of 10-year maturity junk bonds before the pandemic, you got approximately 4% more yield than a treasury. These are the real numbers. Today, it's less than 3%. So you're really not getting compensated to take the extra credit risk. And again, why is this happening? Because so many investors are also not only doing the type of maturity extensions we just talked about. You're an institutional portfolio manager. You've been doing the same thing we've been talking about. You got to extend maturities to get more yield. The other thing you're going to try and do to get more yield is put more credit risk in your portfolio. Yeah. Start buying corporates if you can, or start buying even junk if you can. So, with a lot of a lot of institutions yield shopping in this declining interest rate environment, that's what's also making these credit spreads kind of unattractive for you and I.
Yeah.
I hope there's not too much nerdy talk in that. I'm sorry.
No, it's. I mean, look, it's nerdy. Some people are going to be a little over their heads. Others are absorbing it and loving it. And it's
Good.
This is the type of stuff I think that you don't see on CNBC, and maybe it's because these types of programs dummy things down to their audience, and
They have to. I understand exactly.
it's complex, and there's a lot of facets to this. I mean, you have a whole page over here of things that are happening. So I'll bring it up real quick and kind of read them through. He says, what rates changed today? Well, obviously the Fed funds, that went from 5.5 to 5%. You had the discount rate drop. You had the interest on reserve balances drop by 50 basis points, and the Fed lending facility. So I mean, this is it's not one. It's funny because you watch the announcement today and you're like, oh, this is simple. It's just, they cut 50 basis points. But so many other things have changed today. I for one, am just curious how it all pans out, because I think it's just too much of a cut. But hey, what do I know?
Well, I'm gonna throw out, because your audience is gonna feel it immediately. Go look at the yield you start earning on your money market funds by the end of the week.
Yeah.
You'll be down by 50 basis points. But then the question is, though, I think, Merlin, I've heard talking heads talking about this week, a lot of people are sitting in cash, doing the type of T-bill ladders and keeping it short because that was the best yield. If the Fed's now saying, okay, that game is over, where's all this cash going to go?
Right. Yep.
As we know, there's a huge amount of cash out there.
Tremendous amount.
Yeah.
It's a
Another argument for equities, I suppose. I can't believe I'm saying equity mark arguments for equities.
Yeah. Well, it flows from one to the other. No, it's really going to move from one market to the other. People
Absolutely
move their money where they make the best yield. Sol says, besides bond, what else does Bill like to invest in? Artwork. You can see the pictures behind him. He's got the Pollock on the wall over there.
Exactly, my Jackson Pollock on the wall. Oh, that's a question that's a trap. Let me just say, I have a diversified portfolio. How's that?
Yes.
I will, because we've had this conversation. So I don't trade in crypto at all.
Yeah.
I am an owner of crypto, but I don't trade it.
Yeah, you're a hodler.
I'm a hodler, exactly.
I am too. I would say most of my stuff, it's funny because in the classes, a lot of people want to know about active trading of crypto, and I'm always like, we don't have in my opinion, the infrastructure in the U.S. isn't quite there to support good tools and resources for active trading. You can, but you don't get leverage. You have a lot of illiquidity, but that'll change over time. But yeah, I'm a hodler.
Look at the spreads you're charged. I got fed up with the spreads. God.
Oh, you're using Coinbase Basic.
Exactly.
Yeah, that's why.
Yeah.
No. Yeah, you don't. You know what? I got a class you should take, buddy. Come on, take my.
I should. You're 100% correct, and I've actually put on my calendar once or twice, but couldn't do it. Yes, and if people haven't, they should take your class on the topic.
Yeah, well, some people are totally against it anyway, which is totally fine with me. No one has to be a believer in anything. Believe what you want to believe.
Absolutely.
Last graphic here. I think you had one more slide that I wanted to get to. Hold on, which one was that? Okay, you had that question on the screen, which is, will the Fed destroy $50 billion a month? That was the one that was looking at.
Yeah, and I'm sorry I didn't have the answer for this
yet.
But on the tapering side, because it doesn't make sense if you think about it, this destroying money is a tapering maneuver, which makes rates go higher. Here's the Fed trying to make rates go lower, so it doesn't make sense for them to be destroying the cash in circulation, making it more scarce, and hence the rates would go higher. They're literally, how do I clean this up? Polluting in their own pool would be the term. And the same is true for this repo lending facility. The Fed wanted to suck money out of the economy, so it said to the asset managers and mutual funds, we'll hold your cash and we'll pay you a pretty good rate of interest to do it. They only introduced that in 2022 for the first time. This is the newest of our monetary tools. It doesn't make sense for them to do that and then start lowering rates at the same time. They're working against each other.
Strange.
Maybe that's why it wasn't mentioned in the press conference.
Maybe. I mean, obviously I'd like to see them unwind that balance sheet a little bit more, but you're right.
Absolutely.
Now all of a sudden you're contradicting some of your own actions. And again, time will tell. Good news for everybody here is this will create volatility in the marketplace. We still have a good level of uncertainty. If you watch the press conference, they gave some clarity as far as rate cuts. Yes, we should see some more by the end of the year. Is it a 25, a 50, a 75, 100, 125? I mean, how many more are we going to get? At this rate, it looks as if it'll be a 50 and a 25 at minimum. Most likely, based off their talk track, and we'll check the economic data as it comes, most likely another 250 basis point cuts, which is just mind-boggling to me. I just think it's inappropriate. Part of me hopes
I'm with you.
this sounds bad. I apologize to everybody here. I hope it ends badly for them, right? Because that would be create an opportunity. Maybe the markets crash. I can load the boat at some lower prices. It'll just, it creates opportunity here. I just would like to. I feel vindicated in like a year when they go, well, we shouldn't have cut 50 basis points. Shouldn't listen to Merlin and not Margaret out there. No, I'm just kidding.
As inflation rears its ugly head back at 8%, right?
Yeah,
you'll teach them.
I'm happy to pay $35 for a hamburger just to be proven right.
Exactly.
Oh, the
The
beauty
world
of
we
it.
live in. The world we live in.
All right, you said that you're going to be pretty darn busy for the month of October. What's your upcoming teaching schedule? I know you said you had an XLT coming up, but is your Canary in the Coal Mine class coming up?
Yeah, we just finished one last week.
Oh.
So we're going to get 2 in before the end of the year. So we're going to have an October and a December, but I don't have the dates yet. But yes, we got good demand for those. And I got to tell you what I like about it. I know you teach one also. Is the Thursday, we all do, I think, a once a week companion class.
Yep.
And I like those because it gives us an opportunity to update what's been going on, ask questions on a more informal. So I'm enjoying those Thursday sessions, the companion class, as much as the poker series themselves. But yeah, we'll have 2 more one-day sessions before the end of the year where we talk about this interrelationship between the different markets and kind of demystify bonds and interest rates for folks. Because let's face it, here in the U.S., people don't understand bonds as much as they do equities and a lot of other asset categories.
Yeah, I find that interesting. I find it very interesting on how that whole structure functions. It is one of the more important ones, particularly for those who are older and looking for income streams. Bonds are that staple for a portfolio, yet most people don't really understand how they work. But, I know how to buy an Apple share or Microsoft or some.
Right. Exactly. So we just have to demystify it so we can have the conversation.
Yeah.
So it's been a fun class. I'm really, this work with OTA is my only experience with the retail investor. And I really enjoy it.
There's goods and bads to that. There's goods and bads to that.
Oh, yeah, but you're a lot more fun than my institutional clients. So I enjoy these sessions. I really do, the OTA sessions. I really do.
Oh, yeah. I'm going to shift topics here completely for everybody that's part of the program. As we all know, well, I guess we don't all know, but I'm sure for many of you here today, there are those moments where you look back at and you're very proud of, and proud parent moments. You were talking about your son who is a film producer or director.
He actually is a writer.
A writer.
But he's worked his way into these other functions. But yeah, Merlin and I were talking. We've known each other for years. So I'll share my proud papa moment. I'm sure all of you have similar. But the Duffer Brothers were TV producers who did a show called Stranger Things. I think it's just opening up its 3rd season, and they're kind of very in vogue. They hired my son to write a script for them called The Burrows, which has been picked up as a 10-episode movie series for Netflix. So it's going to be starring Gina Davis and Bill Pullman and Al Molino. And my son is both the writer, the producer, and the showrunner for that show that's being filmed now in Albuquerque. So he 2 years ago won an Emmy for writing a movie called Dark Crystal for Henson Movies. So this is his biggest project by far. And he also has a movie coming out at the end of the year. He wrote a Tolkien script that was approved by the Tolkien family and picked up and made by Fox and turned into an animated movie. Anime, the Japanese anime, not my genre. But so there's a new Tolkien anime movie at a theater near you in December, and my son is the author of that movie as well. So I'm very proud of him.
As you should be. Bill, we might have to see you in a tuxedo on a red carpet someday. Maybe you can be out there with, Lady Gaga and some crazy attire.
I told him I'm ready. Whenever he actually, when he won the Emmy, there would have been that opportunity, but it was the year of the pandemic, so they didn't get everyone together. They didn't.
It's terrible.
He could have, more importantly, forget about me.
Right.
He could have had that opportunity when he was up and won the Emmy for Best Children's Movie.
Oh,
but
man.
It was the pandemic
Imagine
year.
you finally get the Emmy and you're like, sorry, we're closed.
Still looks good on the resume.
You can walk around your living room with the trophy and just pose with it in your living room on a camera. I'd like to thank all the little people.
Actually, they did send them in advance so the winners could do things like that.
Nice.
There was not a lot of secret to that one. Yeah, they had to make do. So yes, I am a very proud papa. He's doing what he loves, and I guess he's good at it.
Yeah, well, I mean, You've had a passion for bonds for a long time. He's got a passion for writing and film and TV. So, hey, maybe he'll be the film king. I've got you as the Bond king. Maybe we can have him something else, a new title for
I'm
it.
ready for that. I'm ready.
Awesome.
I'm ready. So The Burrows, keep an eye out for it next year on Netflix.
Absolutely. I will. I think you got a bunch of people here that'll watch that show, and I have a vested interest in it now. So,
Cool.
all right, Mel. Well,
Cool.
thank you so much. I appreciate you coming on and making sense of the FOMC and all their decisions. We'll November. Oh, you're gonna be busy, but let's see if we can get you on around November 7th on the next announcement. See when time gets there. I know you're a real busy one, but again, we always appreciate
Let's try
you.
and make that happen.
I hope you can. Hopefully,
Yeah.
maybe you can come out here and we can just do it live in my studio.
Man,
at home
I
one
would
day.
love that.
You gotta get to
I
California.
would love that. I'm dying to get out of the West Coast. We'll figure out a way to make that happen.
Oh.
I owe you beers. That's the only thing that's keeping me from going is it's going to tap me out.
I know, right? The airfare's cheap compared to the kegs you owe me at this point.
That's right.
All right, Bill. Hey, thank you so much, my friend. I appreciate it. Have a fantastic remainder of your day, and I will see you next time. Take care.
Great talking to you as always, Merlin. Be well and be well to the group. Thank you.
Guys, that's Bill Addiss, the Bond King. Hope you enjoyed that today. And man, it was nice talking to him and how proud he is of his son out there. That as he should be. That's a pretty impressive feat to be winning an Emmy for the Dark Crystal one, and then all of a sudden, getting a Tolkien film animated. Wow! And I'm a huge Tolkien fan, so I heard that and I was pretty excited about that one. Anyway, yeah, I agree, Big Gab. I am so fortunate that I've stumbled across Bill. I don't know how he crossed paths with Trading Academy, but he's talked about he built a bunch of educational videos and then building the bond program. And I'll tell you, I worked for a financial advising firm for a little while. I've been involved in financial markets, I would say almost all my life, all my professional career. And like you said, most of us don't really understand the bond markets. And I think it's had this kind of taboo mysticism about it for a long time, and I feel like that's changing. I feel like more people are aware of the bond markets and what they mean, how to use them, how to incorporate them into a portfolio, and just glad to have Bill a part of my circle of friends that I can call on every now and again to get some info. So I hope you guys enjoyed that one. All right. I had some interesting graphics for today. I was going to try to do some new graphics. I was talking about some economic drivers, which I was going to talk about Powell's comments, and then unpacking the data, and then is the U.S. in trouble? I like this one. This is a nice graphic that was created by my Midjourney today. And, when that announcement came out, I was in the middle of an XLT general session for crypto, so it wasn't the best timing for me to be trading it. I didn't make any trades off of it, but I will be awake early tomorrow morning looking at shorting opportunities based off what I see here for our broader market indexes. That S&P futures market, I'm salivating right now just looking at this chart with those last two candles showing weakness. You add on volume here. Volume is not abnormally large, but a little bit higher than it has been over the past month, so that's obviously a good sign as well. We get some follow through, could have a nice pullback tomorrow. And again, that's a similar picture on the NASDAQ as well. So NASDAQ came right up to that little yellow box, just almost hit that overhead supply. Now selling off. We'll see if that continues to the south side. And then here's your Russell, which has a just gigantic topping tail on it today, as it had a phenomenal run earlier. If you look at the gains today from yesterday's close, at one point the Russell was up 3.56%. That's a monster day. At the end of the day, only up 0.96. So a lot of retreating going on there for those indexes. And I saw that question come in earlier. Yeah, I think that what caused this was retail jumping into it and institutional closing. So they say retail opened the door, institutions closed it. In this case, that door was closing on selling pressure on equities, locking in some profit into this rally. To me, a 50 basis point cut does signal a little bit of problem ahead from an economic perspective, and I think that's reflected in today's activity. We'll see if that continues. Now, other parts, there's that dollar index. Notice dollar tiptoed down below that yellow box, but didn't close below it. So I'm still counting this as a valid zone for it to stay within this sideways channel here on the dollar index. Really I thought it should have kept on falling today, but bounced right back up. These markets are very interesting. Bay Street Wizard Merlin, what are your thoughts on XRP, AVE, the only few over 200 simple moving average? I like them both. I'll get to that in just a sec. Let me run through our top markets here. Question today was also about gold. Now, here's your gold chart. And I'm going to leave this on here. I'm going to move to the side so you guys can see what happened. It's done exactly what those lines had done. And now, I'm not making this up. We drew these lines out when it broke. The day it broke out, we thought, when the day it broke out, we thought it'd have a rally out, a pullback, and then head to the upside. So in this case, what we saw today was a lot of volatility. I mean, look at the legs on this candle for today. Huge volatility on gold markets. In theory, if you cut rates, you're dropping the value of the dollar. In cutting rates, you drop the value of the dollar, and what that typically means is the dollar is cheaper, therefore more foreign money can come in and buy commodities because most commodities are priced in US dollars. So a euro buys more dollars, a yen buys more dollars, a pound buys more dollars when you have the yield, the interest rates getting cut. So in theory, this may be that one touch that we needed. And at this point, I think you'll see gold continue to the upside. You saw silver today. Also started off real strong, which is fine. I still have I sold some puts on silver as well a couple weeks back, so I'm still going to be fine by this Friday. Again, that's why gold took off today. It's just the expectation that it's going to have much cheaper value of the dollar, and it's two things. Number one is you can buy more gold because the dollar inherently will get weaker because interest rates have been dropped, so the carry trades will unwind even more. This is not good for any of those institutions that are in the carry trade right now. Not good at all. And that may put further equity market downside pressure, at least for the next few days until this settles a little bit. But remember, gold is also a safe haven. If there's times of uncertainty, if there's times of inflation, an unknown, gold has been that go-to piece. And I think the rate announcement today, at least in my opinion, I know some of you don't agree, and that's totally fine, but in my opinion, this does reflect more uncertainty about the future. It tells me that the Fed is saying, we think that there's something up ahead that we want to get in front of because we've been accused of being late to the party. So we'll be more aggressive here. Maybe we're already behind. I don't see that personally, but that means if there is that uncertainty, then there's a preponderance of people who will go to gold. Go to gold, go to silver, platinum, palladium, go to precious metals. So that's my thinking there on gold. Does that mean you will get a soft landing? No. I think what I think happened, if we were to do an analogy here, the plane was coming in at a nice approach angle, just cruising down to the point when the wheels hit the ground, in my opinion, would just gone, boop, little chirp. Now all of a sudden, you've just given it some more gas. So imagine you're on an airplane and it's coming into the landing very smooth. No changes, no jolting back and forth. It's just nice and smooth. I feel like what we've been on. And today's 50 basis point cut to me is like a quick sudden jerk to the airplane, so you hear people screaming on the plane, or they just stomp on the gas real quick and it freaks you out because you don't know what's happening. That's how I feel about the rate cuts today. For the carry trades issues, what are you looking at? USD JPY. I think USD JPY is the biggest one because remember, the Japanese yen was negative for the longest time. You could have gotten money for free in Japan. So you go over there, you get a ton of money. Come over here and you buy US dollars and get a better yield. Now all of a sudden the Japanese yen is increasing in value. So the yen's been moving up, which means I'm going to have to pay it back with yen that are more expensive. And then the dollar's falling. So I have to sell my dollars at a lower price, buy back yen at a higher price. I'm losing money. So anybody who's making these carry trades, especially those who are using hundreds of millions of dollars, they're underwater and today's not helping. Today is absolutely not helping. Sava says the runway got a lot shorter. Yeah, I think that's one way to look at it. I like the analogy I do as being a passenger on the airplane because we're all just passengers. If you're on an airplane, you can't even see the runway. You have no idea what's in front of that airplane. And, when there's a big jolt or they stomp on the gas or, there's a sudden action right as you're landing, all of us go, oh, what's happening, right? I think that's what's going on. Let me real quickly go to Bay Street Wizard talking about AVE and XRP. So we talked about this in my XLT general session this morning on crypto. I'm not a big fan of Ripple. I own Ripple. I've owned it for a long time, but XRP has been performing actually rather well. I mean, I'll be honest here. It's just been going sideways, but considering that all of crypto is going down, this isn't too bad for Ripple. Although, you look at the last year and a half, it really hasn't done much at all. It's slightly uptrend, but really chopping back and forth for the last year. I still think that the SEC is a problem. Even though you have the Grayscale ETF being announced for it, that's only for institutional and for accredited investors. So I don't think that's going to impact it very much. There's other peer-to-peer payment networks and payment structure networks that have stepped up, like Stellar Lumens, and heck, you could use pretty much any crypto now. So I'm not a big fan of Ripple. I own it. I'm not going to sell it right now. I'll sell it next year when we peak out. And then you asked about Aave, which I don't have on my watch list, but I do like Aave. I like these lending protocols. So Aave, for those of you who might not know, Aave is a protocol where you can deposit your crypto and you can do collateralized loans, so you can actually borrow money against your crypto. You can deposit it and lend out your crypto to other people and earn yield on your money. So it's basically like a decentralized bank where you can lend, borrow, whatever you want to do with your money. I like that. There's Curve, there's MakerDAO, Curve, Maker, Aave are some of the bigger ones, but Aave is one of the biggest out there. I'm a fan of it. I like Aave. I think it has a place in the world as a business model. You know, I'm definitely a fan of Aave. The chart looks really good right now. I don't think enough people use these types of services, but I think as you become more and more versed in crypto and what it can do, you realize, hey, I should be using these things to earn some yield on crypto that I was going to hold anyway. So there you go, Bay Street Wizard. Hope that helped out a little bit. Everyone going over. That's right, Chio. Hit that like button. I'm going to wrap up here today. As you guys know, I will not be here tomorrow. Thursday and Friday, I will be headed to the City of Sin, Las Vegas. It's going to be a long day because I do want to trade in the morning, and hopefully I can get some scalp some nice shorts as this market sells off, as I think it was going to do in the morning. So that is 2 days break for me. I apologize. I know you probably want to have a Thursday and a Whiskey Friday show, but we'll have to reconvene on Monday. Reconvene on Monday to get things back on track, and then I'll tell you about some guests that are going to be on the program for next week. Chio, do you use them? I have used them. I don't currently have anything with Aave. I have a little bit with Curve, but I don't use them as much. Most of my crypto is actually staked. So those are lending protocols, which are decentralized, Aave and Curve. Most of mine is staked directly, manual staked by me on those different protocols. So like Polkadot and Cosmos and Solana, I'm doing manual staking on those, which typically give you a higher yield than lending protocols. All right, I think that's going to do it for me. I don't really have any economic announcement. I guess I'll give you tomorrow's economic announcements, which we already kind of looked at. As Bill mentioned, we got a 10-year bond auction, but you can see for the U.S., you've got Philly Fed Manufacturing Index, existing home sales, which has been rather disappointing. Check out the chart for existing home sales. For my show today on NinjaTrader, I was actually looking out there and trying to see what's the negative info, what's the bad stuff in our market right now, and existing home sales was one of them. You can see that it's really been declining. Last 6 months have been going lower and lower and lower, and maybe that has to do with higher interest rates and just not enough inventory. But when we look back historically, check out this chart here. This goes all the way back into 2004, so 20 years. These are some of the lowest housing numbers we've seen in 20 years. That's not good. You know, you would think that the housing market would be much more robust than this, but new home sales are actually doing much, much better than this. So what do we got? We have unemployment claims coming out tomorrow, natural gas storage. You've got quite a bit of stuff happening tomorrow, so just keep your eye on those announcements. You also have, at the wee hours of the morning, you have the UK coming out with their announcement. The Bank of England will be making their rate announcement, and the expectations are right now that it's going to come out at 5%. I'll be honest, I think it's going to come out at 4.75. I think they're going to cut 25 basis points. They did it their last meeting, and I think they're going to do it again based off not only what the U.S. did, but also this MPC bank rate votes. You guys see up here, right above it, it's called the MPC bank rate votes. And what this means is the first number is how many want to raise rates, second one is how many want to lower, and third one is how many want to keep the same. Well, expectations are that 2 want to lower, 7 want to stay the same. The previous was 5 wanted to lower. I don't know. I think we're going to see it come out lower. I think you'll see these numbers come out lower. 4.75 is where I'm figuring out. Anyway, that's it. Economic for tomorrow and earnings is no big deal, so that's going to do it for me, everybody. Thank you so much. Again, if you want to know more about Bill Addiss's class, you can contact Trading Academy. It's called Canary in a Coal Mine is his program. He also has application sessions and XLTs he does as well, so check that one out. And that said, have a fantastic remainder of your week, everybody. I will see you on Monday. Take care.